Okay, we'll get started. Thank you all for being here. Things you need to know. That's the title of our monthly webinar. This is about our fifth one. We did one on price indexing and had 1,000 people sign up. It was just amazing. So welcome to those of you. We got 400 more new ones just this time, at least. I guess our star billing of Lyle Radke did the job. I really appreciate Lyle being here. This is my teddy bear. It's been with me for about 20 years, and every class I've ever taught using PowerPoint. Still doesn't have a name, still looking for a name, so we should have a contest for him. Upcoming events, class next week. If you've heard about StatsCraft's Data Science 1, it's a 14-hour class approved in most states, December 9th, 10th, and 11th. Next month, January 7th, Tim Anderson, Appraiser's Advocate, is going to be with us next month, talking about the conflict between highest and best use and market value definitions. He's also a USPAP instructor. Okay, Scott Reuter, just talked to Scott Reuter. He was going to be here today just to make sure that Lyle did it right, but he had a big, so you escaped this one. But he's coming up early next year, and then we are in the process of writing a class for reviewers, auditors, underwriters, probably 7 hours, not sure yet. Okay, how did this happen? Well, it's a long story. It's an accident. I was a Vietnam veteran, got kind of screwed up over there. I was dragged out of graduate school, believe it or not, to go to Vietnam. I went, came back, and it took me another 10 years to get back to school. I was already an appraiser and just took a pile of classes in statistics, economics, econometrics, a little bit of programming, GIS stuff. All of it applying the question was, how does it apply to valuation? Lyle Radke, our guest presenter, things you need to know. He's the director of FannieMae's Collateral Policy and Strategy team. Hopefully you've all had a chance to read this already. The topics we'll be covering here is bias, or he will be covering, and I'm gonna do a kind of a lead in of about 15 minutes to lay the table for what Lyle's talking about. But it's primarily about bias, reproducibility, which is a new word we haven't heard before, and evidence-based analysis. So the purpose of this webinar is to help you understand the changes that are coming from the horse's mouth here. Be aware of the needed learning that's going to go along with this. We can't continue just doing old stuff with new technology, and it's analytics technology, and understand some of these new concepts and tools. I'll introduce the awareness of why we have to be aware, which is answering the question of why, and the what education is needed, and training, the how. What buttons do you push and what software do you need to get the results that Fannie and Freddie and other clients are going to need in the near future. So awareness is the first step, the why. Just becoming aware that these issues are here. Some of the changes are challenging, in my opinion, and they will require new education and training. The what? Education is the second step in preparing for these coming changes. The clear division here is that appraisers are responsible for making model decisions. You've been doing that your whole career. The cost approach is a model, the income approach is a model, the sales comparison approach is a model. You make that model decision. Those are models. The algorithm is the mathematics and the logic that goes into it. And with computers, basically, we're using computers more and more for the algorithms. And once you punch the button for an algorithm, it's pretty much 100% accurate. We're not dealing with math errors like we did when I first became an appraiser. So the computer handles a related algorithm. The main interface between the human brain, your expert brain, your judgment, is visual, graphs. You tell the computer your understanding through a visual, and the computer gives you back a graph to help you primarily to understand markets. Instead of comparing comps, we're looking at markets, and the human brain is not really good at understanding beyond 5 or 6 data points. With graphs, visuals, we can understand markets. So the education is basically the science of data, moving away from trust me, I've been doing this for 20 years, to the science, the evidence behind it. So our focus is to measure markets, not compare comps. The how do we get there? Training is a third step to enhance your judgment, improve you as an expert, and create that relationship with the data that's out there. Appraisers will need to work with data levels, data types, and graphs. Market condition tools, more than just a time adjustment, including even perhaps forecasting, are the primary learning focus. We'll come back to that. The computer sharpens your judgment. Don't make the computer your enemy, make it your friend. Have it help us. New software tools are available and continuing to improve just as rapidly as the rest of the world is in computation. Probably the biggest single change from the old way of appraising the credibility part is that we separate data selection from making adjustments. The mathematics is completely different. The judgment, decisions that are between picking data and making adjustments is completely different. So we separate those. When I became an appraiser, it was absolutely necessary to intermesh picking comps and making adjustments at the same time. It was just a part of the thought process. But working with computer tools, we separate those two concepts to use the algorithms. I've listened to Lyle twice in the last 2 or 3 months. It was revealing. At the Appraisal Summit, he noted 4 appraisal elements are needed to help reduce the potential for bias or human error. And I'm pretty sure I got this quote exactly right. He said, factual, objective, reproducible, and auditable. Well, it turns out that those are essential elements of good science, of good data science. Bias and the scientific method. Science is a systematic study by an expert in the field of study. This is perhaps probably the main reason appraisers or somebody like appraisers are going to be needed in the future. We're just going to have to learn how to do things different and better. You, the expert, is needed for model decisions. The appraisal process itself is a systematic science study. Even when I became an appraiser and data was really hard to get, the system we had then, picking comps and making adjustments, absolutely was the best science we had at that time. The world has changed now. So let's look at those 3 words. Factual. I looked those up since Lyle used those twice, so both at that conference and in the PowerPoint slides that are coming up. Factual is concerned what is actually the case rather than my interpretation of it or my reaction to it. Bias can influence how we see things. Bias can influence how we react to something. The word objective. Now, I looked all of these up in the dictionary. Not influenced by personal feelings or opinions in considering and representing facts. So let's compare objective and subjective. Objective is free of bias and based on facts. Subjective is not impartial. It is based on somebody's opinions or feelings rather than facts or evidence. So clearly we're moving from the left to the right. That's really the whole process we're talking about here. Reproducibility. Reproducibility is a key element of good science. I do an experiment, you can do it and get the same results or really close to the same results. That's good science. If I state my opinion as this value and you review it and have a different opinion, that's not necessarily good science. It's just a disagreement of opinions. It is a major principle of the scientific method. And auditability. Well, this one in the dictionary wasn't very well explained, but it used the words able to be audited. My college degree, bachelor's degree, was in accounting, so I had a whole class in accounting audit, but it was a systematic examination in great detail, and the emphasis is on the procedure, but certainly not on believability. So we're talking about reliability of the result as opposed to how believable or how worthy of belief are you. Remember in USPEP, it defines the word credible, which is used like about 120 times or something in USPEP. It's being worthy of belief. So be a worthy appraiser. So what is evidence-based valuation? It's a subset of data science where the field of expertise is asset analytics or value measurement or risk analysis, anything to do with assets. Evidence-based valuation blends the best of your judgment and the computer power that you have in front of you. A goal is to provide transparent, reproducible results. By the way, I'm currently on a subcommittee of the Appraisal Foundation, or work group that's developing, are you ready for this? Standards for AVMs. Standards for AVMs. And it's a difficult task, but one of the goals we're tending towards is to create transparent, reproducible results. That's probably going to be a war, not a battle, but that's what we were assigned to do, and that's what we did. It should be fun. Evidence-based valuation also enables, this is important, other critical outputs like risk reliability scoring. What do Fannie and Freddie and our clients really want, especially the loan clients? They want to know the risk of their loan. I think FannieMae defines their mission statement, or that they're managers of risk. And appraisers can help with that job. Rigorous market price compared to the sloppy market price that we've been doing over the last number of years. Of course, I'm cynical about that. Fundamental value. I'm going to Joan Trice's Collateral Risk Network in Florida in a couple of days, and she's got two speakers. One from one left-leaning research outfit, and one from a right-leaning research outfit. And in reading both of them carefully, I discovered they both really would like to find fundamental. So I'm going to try to sit them down together and say, look, you both favor fundamental value as opposed to market price. Fundamental value is a value of a home as a place to live, to sleep, to entertain, to cook, to raise your children. That's the fundamental value as compared to all other goods and services. And forecasts. Relocation appraisers do this all the time. Craig Gilbert is on here is one of the founders of the Relocation Council Appraiser Group. They do forecasts all the time, 60, 90 days out forecasts. This would be a great use in helping with risk analysis for our clients. Update appraisals, revaluations, real-time revaluations become possible. So the future is here today. It's coming down the pike really quickly. Bias, reproducibility, and evidence-based methods. There's more than one type of bias. There's analytic bias and personal bias. Reproducibility, I believe, is the key to appraisal professionalism in the future. Evidence-based methods focus on factual and objective data, as Lyle, I've heard him twice say that in front of groups, and enable objective audit versus an opinion. Remember that in Standard 3, the reviewer is charged with being worthy of belief, being credible about his or her opinion of the worthiness of your opinion. Have any of you ever done a review of a review? I have. So yeah, follow that through. Okay, bias can be personal, can be analytical. Can be personal bias, can be conscious when you're trying to cheat, and unconscious, just kind of our inherent tribal prejudices towards people and things that we're familiar with. It can be analytical, and this is important to me in the curriculum that I teach. Can be a bad selection of a model, which goes back to competency of the appraiser, and it can be an error in the calculations of an algorithm. When I became an appraiser, folks, the 10-key electronic calculator was just still brand new. It was a lot. Today, math errors have just about gone away. But when I became an appraiser, that was a big deal. Bias in USPAP, it says, quote, a preference or inclination that precludes an appraiser's impartiality, independence, or objectivity. It's all focused on the appraiser, not on the work. USPAP is all about appraiser bias. and not at all about any analytical bias. Trust me, I've read it carefully. Not once does it talk about the reliability of the appraisal. It only talks about the credibility of the appraiser. It's all about you, not the work product, even though that's, jumps in there. So analytical bias can be a bad choice of a model. You used a cost approach instead of sales comparison. That could be a bad model and you're going to get a bad result. Multiple regression coefficients is unfortunately still a common error in some of the software we are dealing with. It's bad statistics, it's bad mathematics, and the appraisal of real estate, by the way, specifically says that regression coefficients should not be used as adjustment factors. This is my area of expertise in econometrics. The mathematics between what we do for an adjustment is completely different than the mathematics behind a regression coefficient. Bias can be an error in the algorithm. It can be a math error, a programming error. And I believe that eliminating structural bias in the appraisal process can benefit all stakeholders. Benefits everybody, including us. Benefits appraisers, we can create added value and gain new respectability. It's a help to our collateral investor clients. It can improve their risk analysis by integrating appraisal risk right into the algorithms for portfolio management, for risk management, forecasting. It can help our regulators. I mean, right now we have this very complex system of regulation with 50 states plus, yeah. You wouldn't believe what it takes to get one class approved with all 50 states. It's about $7,000 and probably half-time employee all the time just to stay up with one class, one 7-hour class. Regulators, it can help reduce their costs, improve fairness, and maybe reduce the training expenses. It can help our professional organizations by restoring the technical and professional status that our professional organizations started out with and we're really good at, and we seem to have lost our way there. And it helps the public. This is perhaps the most important thing. It's something that's certainly important to FannieMae. It helps prevent the next economic meltdown. About 5, 6, 7 years ago, I said, what is my mission statement for ValueMetrics? I was kind of going towards semi-retirement, and I'm still semi-retired, but of course this stuff keeps me busy and fun. And I made my mission statement to help prevent the next economic meltdown, even if it was some small way that I could help with that. That's our mission statement. Help the taxpayer. I'm going to skip through these. I've got slides for appraisers here, one for clients. Very quickly, decisions based on objective, measurable reliability versus believability. You can't get inside of an appraiser's brain and measure how good that is or how biased they are, but you can measure results. Reduce the cost of reviewing underwriting, enable timely portfolio update values. Once you got the data right, it's easy. And best of all, appraisers can be rated on their technical competence, not on how worthy are you of being believable. In my mind, this is a little bit cynical. You create one quality, one experience that might help a person become credible who wanted to become an appraiser is first be a used car salesman. Learn how to sell your judgment, your opinion. Support your opinion. Be a good salesman. So a benefit to clients is to reduce portfolio risk, increase competitiveness, and improve speed and profitability because of the consistency that comes from this type of work. I'm going to skip through this benefits to regulators very quickly. Let me just put them up there. I'm not going to read them. But certainly these are things that our regulators want and could join with a common goal with our GSEs, our appraisal organizations, and us personally. And if we can sell our legislatures and be more believable to them, our assemblymen and senators and Congress people and executive branch, that could help also. And of course, help consumers and taxpayers. help reveal false accusation of bias. We've seen some of that, and helps reduce that possibility of economic meltdown. So I'm going to turn this over to Lyle here in just a second. I quoted him when he was speaking in Frisco, Texas at the Housing Wire conference. And he confirmed I got this quote right. Appraisers see their job as an art form. It's hard for them to rigorously explain exactly what they're doing. Now, folks, there was only a handful of appraisers in that whole room, and 300 or 400, mostly real estate brokers and loan agents. Do you think they might have laughed? They did. They were giggling pretty loud. So that's what Lyle said there.
But I didn't mean it as a joke. Maybe this is a good segue, right? Seriously, we consider ourselves to be artists, right? There's a certain magic to what we do, but that is hard for your customers to consume.
Right. And I'm going to give one poke here for Scott Reuter, with something he said at the conference before that I want to. He said, appraisers need to spend time on developing a market conditions analysis in the appraisal. It's truly the backbone of the appraisal. And I loved hearing those words, because a core focus or a starting point in my class, the Stats, Graphs, and Data Science class, is we start out with a time adjustment, because it covers the whole process from getting the right data. Getting the right data solves 2/3 of your problems. So that, I was so happy to hear these words from both of these gentlemen from our two largest. So there's my go. And Lyle, I would like to turn it over for you. I've gone about 15, 20 minutes here. Lyle's going to go for about half an hour. I'll pick it up with another a few slides, kind of going into more detail and a little more technical stuff, and a few graphs if we have time to. In fact, I can do some live program stuff either during or after the class. And then we will open it up for questions directed at Lyle. Cindy will be on there. We have a chat function, so if you have questions, go and chat there. Cindy and Bruce Hahn is also here helping us with that, to figure out which questions are most relevant to the group. So with that, thank you very much for being here, and I will turn it over to Lyle. Thank you.
Thank you, George. Let me first do a video check. So are you all able to see? You should be seeing like a cover page says appraisal risk presented by yours truly.
Yeah, blue appraisal risk. Okay. We got it.
Great. Let me jump forward then. First thing I have to share with you is our legal disclaimer. And basically this says, anything I say, you can't hold it against me. The FannieMae selling guide is the rule book. And if there's any conflict between what I say and what the rules say, then you go with the rule book. This slide here talks about who we are, right? Who is FannieMae? What do we do? We are a business. There's sometimes some confusion about what's FannieMae's role. We are not a financial regulator. We are not the appraisal police. We're in a business, and part of our goal is to make money, just like any other financial institution. But we have a charter from Congress. So Congress created FannieMae, and they created FannieMae back in the Great Depression because there was a need to restore liquidity into the particularly the home mortgage market, which had really gotten squashed by the Great Depression. And the charter has been modified by Congress since then. I think 1968 was a big change, but essentially, we are a company that was created by Congress for a specific mission, and that mission is to provide liquidity in the housing markets. So we try to make money while we're at it, but we also have kind of this dual mandate of trying to serve our mission, which is the better good of society, right? Now, one thing I want to say before I go any further is George and I did not collaborate on these presentations. You're going to see some parallels. Now, I know he has seen me talk before, and maybe he's picked up a little bit on some of the things I say, but he's been out there talking for a lot longer than just my last two presentations, right? And I think he has been consistent in his theme throughout his career. So it's interesting to me. This is the first time I've heard him do a formal presentation. We've talked informally, but this is the first time I've seen him do ginning up a PowerPoint, right? And it's very interesting how alike our thinking is on so many of these things. Now, I will say this: my educational background, which you might have picked up in the bio, is in science. I have a master's degree in geology, which is a scientific discipline, of course. And in science, you're required to defend your opinion, but not only defend your opinion, you have to persuade. What happens with in the scientific method is, first of all, you go out and study and analyze. You ask yourself key questions and come up with a hypothesis, and you test that hypothesis. And then you've got data from your test, and you publish that data. You publish you try, if it's good science and of interest to other people, then you publish it in a scientific magazine, a journal. Before they'll let you publish it, it gets reviewed by a bunch of people, a bunch of your peers, scientists, before you publish, not after, right? And if they don't like it, you won't even get published. But if they like it, you can get published. The fun stuff happens after you get published. Everyone else tries to tear you to shreds, right? That's how it works. And if you survive, then that's good science. That's how you establish good science, is you survive the criticism. And you survive the criticism by being, first of all, factual. You can't misrepresent. Every now and then you'll hear in the news media about some great study that was very influential in our society, and it turns out they lied. They weren't fact-based. Boy, that's the death of a scientist, right? And sometimes the data doesn't go where you want it to go, but the data is the data. You have to start with the facts. And then you try and explain those facts. And it's really arguing about the explanation that takes you from the hypothesis to the theory status. Now, that said, we use a lot of charts and graphs because we're trying to persuade our reader in science. And I think that's where appraisal reports are starting to embrace that same idea. You have to persuade. You don't persuade by being non-factual, you persuade by being more factual. This is a rational way of approaching the world. All right, so Fannie Mae's business model. Lenders in the primary market originate loans. We publish standards, our selling guide, as to how we want those loans to be originated. And if the loan meets our standards, then the primary market lender, the bank or the mortgage company, can sell that loan to us. And this is a capital exchange that allows them to kind of replenish their coffers so they have more money to go lend. Well, we don't have infinite amounts of capital either. So what we do is we securitize, meaning we issue bonds on we issue debt. We borrow money to then reinfuse into the process. And we commit to pay back that money that we've borrowed using the proceeds of the loan as it gets paid. As you pay your monthly mortgage, a chunk of that money comes to Fannie Mae, and we pass it through to the bondholder or the lender, our lender, right? So the capital markets, they're very interested in our future success because we've committed for a 30-year stream of payments on these bonds that we're issuing, and they want to know if we're going to have the money to pay it back. And part of the question of whether or not we have the money to pay it back is how good is the loan in the first place. Sometimes loans default, right? And how you manage that default is really about how good your margin is. The more effective you are at managing the default, the better your profit margin, so to speak. That's where you take your losses. It's all gravy until somebody defaults on the loan, right? So part of what determines your success in managing the default is you may have to sell that property to recoup the loan balance. So did you get the value right? Can you sell it for what you thought you could? And that's where you get the money to recoup your loss, to then pass it through to the bondholder and make everybody happy. So to us, Fannie Mae, the value of the property is extremely important. Let me jump to the next slide then. Importance of value. Loan to value ratio is how we price our loans. We have different pricing levels for different loan to value ratios. We call those LLPAs, loan level price adjustments. We also have, by congressional mandate, We get credit enhancements, or which is essentially mortgage insurance for anything over an 80% LTV. So again, whether or not we have this secondary insurance is dependent upon the value that the appraiser generates. And if that value is off, we may be underinsured or we may be overinsured, right? And the same thing with how we price our loan. If the value is wrong, then we may misprice our loan and we may not charge enough to pay for the risk that's intrinsic to that loan. So the value is extremely important to our business model. It's the baseline of how we price everything that we do. Imagine, you're Walmart and you sell groceries. You have to know how much those groceries cost in order to figure out how much you're going to charge for them. And you also have to know what your operating costs are, right? So they're in a competitive situation, but they need to have an accurate pricing model because they do a lot of volume and they're going to lose money over time if they aren't accurately priced. Same thing with the secondary mortgage market. We do a lot of volume. We have to know our long-term risk in order to accurately price. All right, so let's talk a little bit about appraisal quality. Value accuracy is the thing, right? We need to get the right value from the get-go. Inaccurate values cause us to misprice loans. Overvaluation can increase the default risk. Poor quality not only hurts FannieMae and our investors, but it hurts you as a group for the appraiser profession because it undermines your credibility. What do we as appraisers have fundamentally more than anything else? It's our good name, right? That's what we are selling. So I have a skill set. I am ethical, I am competent, and I can give you a useful value. When that doesn't happen, people start to doubt whether or not the profession can back up its business model, right? That's bad for all of us. And then last of all is we've been in an up market for so long. The home price index just keeps accelerating and rolling forward. That tends to hide a lot of issues, right? If you got that appraisal totally wrong, and we used to see that. I saw this so many times back before the financial crisis. In 2003, you get an appraisal that's 25% inflated. By 2005, that thing's back at par because the market went up 25 or 30%, right? So even though that started with a bad appraisal, you sort of have coverage because you've got this rising tide that saves your butt from disaster, until the markets reverse course and go back the other way, like in 2008, and then you find you really wish you hadn't have overvalued that property in the first place. So we've been in one of these positive market cycles now for about 10 years, and that may be hiding a lot of issues, and that's a big concern. Now, there are some real differences between how we did things before the financial crisis and how we do them after. I don't have time to unpack all that today, but we've already turned a corner in terms of use of data and analytics to sort of guard against value inflation right up front, which we didn't have in place previously. You all are familiar with sort of the basic landscape. We created the UAD, we required the UCDP, and then we created CU and other tools like that do risk scoring. So we are able to look at an appraisal. The appraisals are now machine readable. And so the computer, the models can look at it and say, is this thing an outlier? And if it is, you can flag that for putting human eyes on it and see what's going on. And that's what we're doing. I would say that's substantially safer than what was happening back in 2006, which was the lender sent you a little note that says, hey, we got an appraisal and it looks great, done, right? And that's all we got. There's a little note saying it's great, it's good. And you never saw the appraisal at all until you were in REO and you're like, how come we're selling for 75% less than it appraised? I wonder what happened here, right? So by then it's too late. Well, we're in a much better situation today than we were then, but we want to continue to drive excellence because that is, like I pointed out on the first slide, it's fundamental to our business model. So what are some of the headwinds? First of all, not everybody shares the same view of risk. So in the primary market, you make money by originating a loan and then you sell the risk to Fannie Mae. They want to close loans, right? Now, they're my customers. I'm not going to say anything bad about them, right? They help me make money. And there are a lot of really good lenders who do their very best to adhere to our standards. So as a group, I think we have a good relationship. There are a lot of good, honest people, good players out there. But there's always the fringe, right? There's always that around, and there's always the unintentional issues. They have different incentives, and that leads to different biases, and some of that's even unconscious. They want to close loans, and sometimes getting a higher appraisal will help them do that. And so we see in our data that somehow there's this pervasive pressure on the appraiser to increase the value. And that comes through loud and clear in what we see in our data. And I'll show you some data slides later. So why do I do these webinars? Why am I out there speaking? George says he's heard me speak a time or two. It's because I want to get to FannieMae benefits when we can share our view of risk management and our mission and our business model directly with appraisers so that you understand what we think your role needs to be. It's not about getting the loan closed. That's great. Close the good loans, right? But once in a while, you got to be the brakes that say, no, not at this price, right? Better off if you do this at a little different price. And we really need you to do that. That's so fundamental to the importance of this relationship and why appraisers exist, period. So I'm out here talking about this a lot. So then let's talk about, what is the role that we need from you? And it starts with what is an appraisal, right? We'll go back to USPAP here. USPAP defines an appraisal as the act or process of developing an opinion of value or the opinion of value itself, right? I've highlighted or bolded here opinion. The definition of an appraisal is that it's an opinion. Now we all know, or we should know, it's a professional opinion, and the standards define a process that you use to develop that opinion. So it's not the same as my next door neighbor's opinion of what my house is worth, right? You're a professional. Yours is better than that for all these reasons. But it is fundamentally, it's an opinion. It's not a fact, okay? And that has some repercussions, which we'll talk about. So what does USPAP say about how to judge your opinion? And the fundamental metric, I would say, we'll call it a metric, but it's not really a metric. The bar, the measure is, are you credible? Are you believable? Are you worthy of belief? So that's a really interesting metric, right? How does USPAP go about trying to achieve credibility? Now, it doesn't say this. These next 4 points here, this is Lyle's interpretation of USPAP, right? Just as an observer. This is not what USPAP says, but this is how I see it. First of all, it establishes credentials, right? Your training, your experience, your licensure. I hang out a shingle that says, I have done something to make myself good at this. I'm better than the layperson, right? No different than when I go get my haircut, which you can see I have to do often. The barber has got a little certificate there that says they've been to barber school, right? They're qualified to cut my hair. Okay, so then what's next? Character, ethics. We have the ethics provision. We have the competency concept, right? Our character matters. People need to know that we are trustworthy, that we are honest, that we are competent and capable. So we've got our credentials, we've got our character. What do we do next? We've got a development process. We're going to follow certain steps to develop our opinion. Now, I would argue these are all inputs, right? I'm inputting into the process a person with training and credentials, a person who's ethical and competent, and a series of steps that I'm going to follow. So far, we're not measuring output. This gets back to what George said, right? We're not measuring the bias of the output. We're only measuring the inputs. Now, the fourth one is the report. But I want you to think really carefully about standard two. Is standard two measuring the output, the value opinion? Not really. Okay, it's measuring the process of how you create the report and what you put in the report. So it's more input, it's not output. When you get to the bottom line, I agree with George, and we did not collude on this. This first time we've talked about it, USPAP really doesn't say anything about your output. It's all about your inputs. Okay, now what matters to your customer? Do they care how you did your process? No, they were done at step one. You're an appraiser. Okay, they care about the output, the number. Fannie Mae is trying to price the loan based on your value. Your value needs to be a true, factual representation of what's happening in the marketplace. There's nowhere in USPAP that really addresses that. USPAP says that's the goal, but it doesn't talk about how you measure that or how you ensure that that has happened. It only talks about these inputs. Okay, so credibility, how you're measured, is based on credentials and process, not results. Well, let's talk about some headwinds or some challenges to credibility. Headwind number one is the evolution of data. Now I'm going to start in the 1980s because that's pre-FIREA, pre-licensure, pre-USPAP. And that was the landscape from which USPAP emerged. It's pre-internet. Think about the technology situation. I was in college in the 80s. I had a roommate who had a Mac. That thing was fantastic. We loved that thing, right? But he didn't talk to any other Macs on his Mac. It was just his Mac, right? If you wanted to do something fancy, you go to the software store, you buy a floppy disk, and you put the program on your computer, and then you do everything. It's all self-contained, right? There's no talking to other computers. Now, there's a little bit of internet in the academic circles, but broadly in society, there was not. Okay, so what happened after that? In the 1990s, you know the dot-com boom, right? The internet exploded on our world. And what happened as a result is everybody was trying to figure out how to digitize everything. If you can turn it into dots and dashes, right? You can get your computers to talk to each other because everything in computers is written in binary code. It's a 0 or a 1. So you have to turn everything into zeros and ones or a series of zeros and ones. And that was what drove the dot-com boom, is everybody was putting money into digitizing everything that they could think of to see if they could commercialize it. And we loved it, right? That's why we still have the internet. That's why Amazon has become the world's greatest retailer, is because it works. Okay, what did it do to the real estate profession? You started to see some digitization. So you could get public records online instead of having to go down to the county courthouse. You could start to see listing photos in some of your MLS listings, right? Digital photos. So we're starting to see some very modest digitization of real estate data. Fast forward to the 2000s, right? This thing goes full bore on us right now. We have really robust online listing services like your Zillows, your Redfins, your Realtor.coms. A lot more pictures, a lot more data. The MLS becomes available broadly, right? You start to see AVMs starting to emerge. Zillow's floating out of free AVM, right? So lots and lots of data going online. Now in the 2010s, the GSEs, sometimes you think of us as leaders. I'd say we are laggards. We follow in a lot of ways. We get in the game. We're maybe 10 years too late, but we came up with UAD and UCDP. We digitized your appraisal, and we collected that digital data. We started to look at it and do stuff with it. And it turned out to be extremely beneficial to us in terms of managing our risk, helping us prevent the kind of bad behaviors that led up to the 2008 financial crisis. Now, I'm not one of those people who puts this all on the appraiser, right? It's not. There were a very complex set of events that happened, but appraisal was part of that mix, okay? And there were problems with appraisals in some cases. So we get to the 2010s, and now you're starting to see lots and lots of digital data, both in the listing space and in the appraisal space, and in other ways, public record space. And we can start to build models on this. We can start to build tools on this, and we're giving those tools or selling those tools in some case to lenders. Lenders start to become very well informed about property and about markets. Okay. Now, I want you to think about what that does to the concept of credibility. Bring it full circle, right? In 1989, in order to be believable, how high was the bar? The lender had no information. Okay. You were the only game in town. If you said it, they had to believe it because there was no alternative. There was no no transparency and no way for them to critique you, unless they happen to be a local lender who was really active in that local market and had some knowledge of their own, right? But for a big national presence like FannieMae, what's going on in Casper, Wyoming? I don't know. This is the only loan I've gotten there this quarter, right? I mean, that's how it was. So fast forward to 2021, lenders have a tremendous amount of information. They can see things that maybe in some cases you can't even see, right? They can also do analytics because they have economy of scale. They can pay for economists and programmers and data scientists to build tools to interpret this data. And so they're all over it. And FannieMae has contributed to this because it's really important to our business model. So lenders know an awful lot. Now, how many of you have ever gotten a question from a lender? It's like, hey, there's these 3 sales in the neighborhood that you didn't mention, and they seem to paint a different picture. Why didn't you do that, right? Why didn't you talk about them? That maybe didn't happen in 1989. That happens all the time today. That's an example of how lenders have more view into local markets. And they may even challenge you on your adjustment. Everyone else is adjusting X. Why did you adjust Y? They couldn't have done that previously because there was no transparency into adjustment rates. So what happens is this raises the bar on credibility. In order to be believable, you have to be accountable for what your customer knows. And if their context is different or paints a different picture than what you're trying to paint, then that reduces your believability, causes them to question your outcome. Now, I think that the answer to this is still factfulness, truthfulness, right? If you deal in truth, you don't have to worry. You do have to be thoughtful, right? You have to be good at what you do, but you don't have to worry. Where you get into trouble is if you ignore facts, right? There is other data that paints a different picture, and I'm zigzagging away from that. That gets you into trouble because nowadays everyone can see that. It's no longer just between you and the wall. Everybody knows. Okay, so it's a really different challenge for the appraiser today in terms of credibility. It's going to accelerate. There's more coming, right? There are a lot of interest in new technologies, GIS, which stands for Geographic Information Systems. One of the things that we've noticed in our UCDP data is that if we get multiple observations, we call that, or reports from different appraisers on a specific property, let's say it's a comparable in Miami, and we ask in the UAD, tell us whether there's a water presence. Is it waterfront? Is it water view? Tell us a little bit about the type of water, right? And the type of view. So we ask those questions as part of the UAD. You'd be amazed at the inconsistency. I can look at one comp when we've got, it's been used 10 different times with 10 different appraisers, and 3 of them said it was waterfront, and 4 of them said it was water view only, and 3 of them said nothing about water whatsoever. I don't know what to believe, right? So we put eyes on it. We put a human being on it, and we say, go find out, is it water or not? But in the future, we're going to try and use GIS to determine that. So GIS will hit a database, and the database will say, I've calculated based on geometry, there's a direct line of sight to the ocean. Okay, it's water view, right? And if you didn't call it out, then the system is going to flag it and say, well, this comp is actually water view and they didn't make an adjustment. That's a pretty serious omission. So we're not there yet, but that is where this is going, and we will get there eventually. Again, if you're factual, truthful, nothing to worry about. We're going to use other types of data, and one that I really like is the 3D scanning technology. So I can't tell you how many times I've looked at 2 or more appraisals on a property and they've measured the house differently and came up with different square footage. And when your square footage adjustment is like your biggest adjustment, then it really matters, right? The square footage is a fact. It's not an opinion. The house is what it is. The question is, do we have the skill set to identify or describe that fact accurately? And these new technologies will allow us to do that in a reproducible, auditable way. In other words, the 3D scanning app always works the same way. I can put it in the hands of 10 different people, send them out to the same house. They'll all come back with the same answer every time. That's reproducible. And you can look at the algorithm and see how they generated it. That's auditable. That's what we're looking for. That leads to fact. The house just is what it is. We don't want to be arguing about how big the house is, because that's a fact. There's no reason to argue about it. So that's something that we're really excited about, that technology and the capability of turning this into a fact-based exercise. And we see that as being a great assist to appraisers. Instead of having to worry about how to measure a house and what to include and what not, you get to focus on the fun stuff, which is the market interpretation, right? So there's a lot of new technologies out there that I think are going to come to bear on the appraisal profession ultimately. Time will tell. All right, let's talk about another challenge to credibility. We've all seen this in the news, right? Accusations of racial bias. You get an appraisal on your house, and maybe you're a minority, and you're unhappy with it, and so you complain to your lender, and they say, well, let's send out another appraiser, and then you take away all your pictures and anything that gives away your identity, and maybe have your white friends stand in for you, and magically the appraisal comes in much higher than it did the first time. This undermines the credibility of the profession, right? Now, there's a lot of things that could be causing this. So I'm not trying to say that appraisers are racially biased. That's not my point here. My point is, when these things happen, it undermines our credibility. And there's a reason why these things happened. And it goes back to this right here. You're dealing with an opinion. If you were dealing with fact, it wouldn't be challenged. But an opinion is much easier to challenge than a fact. So the basic construction of our industry is we are challengeable because we're not factual. And so to the degree possible, it's not, ultimately the value is still going to be an opinion, but all the inputs into that value, the more you can drive them into fact as opposed to opinion, and the more that you can demonstrate to your audience how you did this so that it's reproducible and transparent, then the less opportunity there is for them to challenge you. I'm going to talk just a little bit more about audit, right? George mentioned audit was hard to define. He looked in the dictionary and it was a circular definition. We at FannieMae are regularly audited. We have an audit department and they don't have enough to do. And so they go round and round every couple of years. I get an audit. And FHFA also audits or examines us, right? One of the things that the auditor does, and this I think is typical for business audits, is they ask you for your policies and procedures right up front. They say, what are the rules of your game? How do you represent that you're supposed to do your job? And so we give that to them. Well, here's our policies and procedures. And then what they do is they go through your outputs and they try and find places where you failed to follow your own rules, right? So they're not necessarily saying, I think you did a bad job. They're saying, your own rules condemn you. You didn't follow your own rules, right? That's what an audit is. And so a good audit outcome is, I said I was going to do this, and anybody can come along after me and look at the paper trail and say, yes, you did what you committed to do. Done. That's a good audit, right?
Lyle,
All right.
your slide is on biases, anchoring bias and confirmation bias. Is that where you want to be?
That's where I want to be. Yes.
Oh, okay.
So I'm talking about audits because you talked about audits, but
Right.
but no. So bias. We've got these two kinds of bias. Anchoring bias. There's actually lots of other kinds of bias. These are just two I picked out of a long list because they seem more applicable to appraising. Anchoring bias is relying too much on pre-existing information or first information we see. Great example of this is we give you the purchase contract and you appraise to the purchase contract. Okay, you anchor to it, right? Now, sometimes that purchase contract does represent market, and you should be appraising a purchase contract, but you don't want to assume that that's the case. That's the thing you need to test. That's what your job is to test that contract to see if it is at market or not. It's not to presume that it is at market and therefore to support it, because that's confirmation, or that's anchoring bias. Confirmation bias is favoring information that confirms previously existing beliefs or biases. Now, I'd argue racial bias is a subset of confirmation bias. If somewhere in our psyche we're saying, well, that side of town, which is populated by those kind of people, always has lower values, that's a confirmation bias, right? These two references here on the right, those are articles that have been published by people at FannieMae, which provide quantitative evidence that anchoring bias does happen. So I'm going to share just a little bit of our evidence with you. Let's talk about comparable selection. So in our REO space, we commonly get two appraisals. We get an appraisal at the listing stage, pre-listing actually. So there's no list, there's no contract, there's no sale. It's a completely open-ended assignment. And what I'm going to show you here is when you compare the price of the comparables that the appraiser chose for that pre-listing REO appraisal to the much, much later sale price that happens. What's the distribution? Okay, look at this yellow line. It's just about a bell curve, right? It's pretty broadly distributed both above and below that ultimate sale price. And I would argue that's pretty neutral. So appraisers doing the right thing. They're choosing comps based on physical characteristics. There's a dispersion around that ultimate sale price, which is a natural artifact of the real estate market. Okay, now let's look at what happens when we get our second appraisal. Second appraisal happens after the contract is signed, and it's for the mortgage lender who wants to originate new loan to facilitate the purchase, right? Red line here. You notice how that distribution changed. Now all the comps the appraiser's choosing are just a little bit higher than sale price. So they changed their behavior. They went from choosing based on physical characteristics when they had no target to hit, to changing based on price when they have a target to hit. Okay, that's a concern, right? You shouldn't change your comp selection based on your anchoring bias. But it happens. All right, let's talk about the next one. Confirmation bias for refinances. Now, in this case, the lines represent different LTV thresholds. And remember, LTV drives our mortgage insurance and our loan pricing. So at a low LTV, and here with the yellow line, LTV is 60, means there's really no impact. The appraisal doesn't matter very much because there's 40% equity in the property, right? And it's not going to affect either pricing or insurance. And then you look at how close that appraisal came to the borrower's estimate, which we receive at loan application prior to the appraisal. And you see it's very widely dispersed. It's a very flat distribution. The appraisal is all over the place relative to the borrower. Or you might say the borrower, in a lot of cases, just doesn't know what their property's worth, right? And the appraisal figures it out. Okay, so very flat, right? Now at 80 LTV, which will be the blue line, the value becomes a lot more important because you're either going to have to get insurance or not. and that can disqualify a borrower if they don't have enough money to pay the premium, right? Certainly, it's a cost to the borrower that they want to avoid. Look what happens to the distribution. So that appraisal, the blue line, much more likely to come in at or above the borrower's estimate when it's an important decision, when everything's on the line, right? Now, same thing with the red line, 95 LTV. At 95 LTV, it's not just about getting insurance, but now it's about pricing and it's about eligibility. Like, you go much higher, you can't get a loan at all. Okay, so this is do or die time. And now our curve is no longer flat or evenly distributed, but it's a big bulge on the right side of that line. Appraisals are coming in higher than the borrower's estimate routinely when it's at 95 LTV. Okay, so that's, again, there's no reason why this should be true. Like, the LTV is not something that the appraiser needs to factor in their process. Why would LTV drive results like this? And the answer is, we believe it's bias. We believe in some cases, the lenders are pressuring the appraisers and the appraisers are coming in, or the lenders are subtly suggesting and the appraisers are anchoring around that. Now, the good news is, if you look at the y-axis here, even at the peak on the red line, we're talking about 11%. So we're still getting, a high percentage of really good appraisals. This is a tail and it's a problem, but it's not every appraisal. I'm not trying to condemn every appraisal. Okay, so in this context, then, we have built up defense mechanisms. Number one for us is what we call our Loan Quality Center. This is a post-acquisition quality control outfit, and they sample appraisals. We do targeted sampling, so we use our collateral underwriter risk scores to select appraisals that we think are potentially problematic, and we have highly skilled appraisal reviewers look at those and figure out whether or not they believe the appraisal to be reliable. And then we will issue findings or defects to the lender when we find cases that our policy expectations weren't adhered to. In some cases, one of the remedies of this process is that the lender has to buy the loan back. That's catastrophic for the lender, especially for the smaller lenders, right? They're not sitting around with $500,000 to go give back to Fannie Mae. They went and loaned it to somebody else already. So this can be a real pain point for our lenders, which are your customers, right? If you want to help your customer, one way to do it is to prevent buybacks, and that means your appraisal needs to be reliable. Now, we take a really systematic approach to our quality control. And this pyramid sort of represents it. This is how Collateral Underwriter is designed and built, but this also reflects our thinking on how we approach QC. We start with data integrity. Are the descriptions and the information presented factual or verifiable, right? Again, getting back to the factual, a house is a certain size. It has a certain number of bedrooms and bathrooms and garage bays, and it is a certain age, and it has a certain lot size. These things are just facts, right? How often are those things in dispute? All too often. And that's part of the challenge for us. But that's where we start, is let's see what we know about it factually. Second thing we look at is comp selection. So are the selected comps representative? And we have a large pool of sales transactions all over the country that we look at as potential comparables. And then we compare what we see as potential comparables to what the appraiser provided to see how they compare, right? The third thing we look at is adjustments, or adjustments based on typical market reaction. And we use statistical analysis to try and derive from the data what would be the typical market reaction. You could think of it almost like the paired sales or approach, just on super steroids, using millions of pairs instead of a handful, right? And then reconciliation. So you go through this whole process, you got your comps. Did you somehow skew relative to where the data seemed to point, right? Now, I'm going to make a bold statement here. The truth is, comp selection actually doesn't matter. You put so much effort into comp selection. Everybody's looking at your comp selection. We argue about comp selection. It doesn't matter. If you have your adjustment rates right and well established, you're going to get the same answer no matter what comps you use. It's all about the adjustments. It's not about comp selection. In fact, in reality, if you understood our architecture, we do adjustments first, and then the algorithm chooses the comps that have the fewest adjustments. That's all. It's that simple. Adjust everything, and then choose the ones that have the fewest. Done. Um, so we don't select comps, really. We adjust them, and then we see where they take us. All right, as part of our QC, we also have what we call our appraiser quality monitoring, or AQM. And the AQM has a different audience. That's the main difference. So our LQC talks to lenders about the loan, and the appraisal is part of the loan. AQM talks to appraisers, not to lenders. And we don't even share necessarily what we're saying to the appraisers with the lender. We go straight to the appraiser and we say, we may send you a letter. And here's an example of a letter. I've looked at 25 of your appraisals and you said C3 on all of them. That seems improbable. So we looked at the pictures and we found these two, which are clearly C5, and this one, which is clearly C2, and just wanted to, point this out to you and encourage you to up your game, right? So we do some letters like that where they're just coaching aids really for appraisers on how to get better. In some cases, we also send letters to states for really egregious matters. And when we send letters to the states, this pie chart over here tells you what the issues are that we're reporting to the states. In a lot of cases, it's comparable selection. Now, again, I would argue comp selection really doesn't matter if you got your adjustments right. But it's a very easy thing for people to conceptualize. And it's an easy thing to criticize also. And so it makes for a relatively easy referral. But we also refer for these other types of issues, going back to our pyramid. All right, so let me jump back to some data. And this is when we look at net adjustment rates, and we're going to divide this into two populations, comparables that are superior. Now, how do we define superior? Just means that your net adjustment is negative. In other words, you, the appraiser, have told us this house is better than the subject, and I had to adjust it down on the whole. And inferior comparables then are the opposite. That's like you told us that you had to adjust up, which implies it's not as good as your subject. All right, so when we take these populations and we look at how our model adjusts, yellow will be the model adjustment. And you see that the model distribution of adjustments is about flat. It's adjusting in a very similar way on the superior comps to the inferior comps. Like for an inferior comp, it's about a 3% chance that it's going to adjust down 7%. And on a superior comp, it's a little over a 2% chance that it's going to adjust down 7% on that same difference, right? So very similar adjustment rates for the superior and the inferior. Now, what do appraisers do? This is real data, okay? What you see is on the inferior comps, appraisers are more likely to adjust up, where on the superior comps, they're less likely to adjust. Okay, or they adjust smaller. So you're adjusting smaller downward and bigger upward. What's that? That's bias. Okay. Let's look at GLA adjustments. Here's what homes actually sell for, price per square foot. This is broken out by state. Okay, and you see over here on the far right, the most expensive place, price per square foot, is Washington, D.C., followed by Hawaii. The cheapest places, price per square foot, are Mississippi and, believe it or not, Puerto Rico. Now let's look at how much appraisers adjust for price per square foot. All right, so about $45 is typical. but it's almost flat. Like there's hardly any relationship between what properties actually sell for versus how much appraisers actually adjust for it. Is that right? Can that be right? Is there really no relationship between sales price and adjustment rate for like the key thing? The square footage is what people live in. And we do see one anomaly here. This is for Guam. Isn't that fascinating? In Guam, they adjust a lot more per square foot. I will tell you, I think Guam has a small number of appraisers. This could be one appraiser who's just adjusting at a higher rate than everybody else. Now, when we look at our modeling, our analytics, we find that appraisers routinely under adjust. We think that the market is telling us that the adjustment rate per square foot should be a lot higher, almost universally. All right, so there's the bottom line. Appraisers adjust $30 to $50 per square foot, regardless of location or price tier. So let's recap our challenges here. Credentials and the established appraisal process are insufficient mechanisms. Why are they insufficient? Because they produce an opinion. An opinion is vulnerable to dispute, and the dispute process is expensive for everybody in business because we all have all these QC overlays. And it's also bad for you as an appraiser because it undermines your credibility, which is the only thing you have, right? Your good name. And you're then open to challenges from people who come out and say, well, I got two appraisals from two different people and they're wildly different. And the reason must be because one of them was biased. Well, maybe it wasn't that reason, but that's the public perception, right? You're exposed because you're dealing in the world of opinions rather than facts. Okay. Second of all, clients approach value holistically. Doesn't matter if your report looks tight. If I can't resell the property for what you tell me I can, then as a business, I am hung out to dry, right? That's credit risk for me. I need accuracy. Market value needs to mean that I could actually turn around tomorrow and sell it for what you just told me I could. Clients approach value holistically. What does this mean? I've gotten this question sometimes. Lyle, what do you mean holistically? They don't look at 3 comps and say, oh yes, that's the answer, right? They're looking at all of the data that they can get their hands on and trying to rationalize and synthesize all of it. And for FannieMae, that might mean we may look at 100 comps or 1,000 comps in our model and try to synthesize that. And so you have to take more of a broader approach. You can't just say, I'm assuming nobody can see what I didn't put in the report. They all see it. That's holistic, right? Appraisal reports lack consistency and reproducibility. Anybody who's done jumbo lending knows this, right? A lot of banks will require 2 appraisals on a jumbo loan. You send out 2 appraisers, what's going to happen? You get 2 different answers. Now, in your best case scenario, they're close together, but there's an awful lot of them where they're not close together. They can vary by huge, huge amounts, right? That's not reproducible. I ought to be able to send any appraiser out to any property and get basically the same answer back. That's not happening today, okay? Lack of certainty then leads to inefficiencies in the system, where we have lots and lots of QC and lots of argument and swirl, and that's no good for anybody. Right, so I want to talk about here's the bottom line here, FannieMae appraisal policies. What's our aim? We want to increase accuracy and reliability. So we want to take that foundation of USPAP, which is good, which is you are ethical and you are trustworthy and you are competent and trained. You're a specialist, you're an expert, you're a professional. That's a great foundation. We want to take it one step further and say, what you're giving me back is accurate, represents the market as of today. It's reliable. I can make the business decisions on it, and I'm not going to get hung out to dry later on. Okay. So let's talk about technology a little bit. And here's where George got his factual, objective, reproducible, audible. I put those here because technology can help you get there, right? And I use this example of the 3D scan. The 3D scan will always spit out the exact same GLA for the house. Okay, that becomes factual. Is it objective? Yes. It's a dumb box. When they created the algorithm, they had no clue which house you were going to use it on. So it's not, it doesn't change based on your house. And they have no clue who's going to hold the device. So it doesn't change based on who's holding the device. They have no clue what loan transaction it might be used for. So it doesn't change depending on the loan transaction. It's completely objective. It always works the same way every single time. Okay. That makes it reproducible, right? And that makes it auditable. Okay. Another thing we're going to do, mentions here, this first bullet, is that we've really focused on selfishly on Fannie Mae's needs all these years in terms of overvaluation. But now we're seeing that there's concerns about undervaluation. Is undervaluation a problem for a borrower? Yes, it cheats them out of opportunities. And so we're going to create some analytics around that and share that with our customers as well. New technologies, we've talked a little bit about these things: GIS, 3D scan, machine learning. Machine learning means we teach the machine how to read a photo. Turns out this is a lot harder than it sounds, because a digital photo is a series of dots and dashes, right? Ones and zeros, like millions of them to assemble a photo. The machine doesn't look at that and see a house or a face or a range of them. It sees a bunch of dots and dashes. So trying to teach the machine to convert dots and dashes into sort of a recognition of this is a bathroom is really hard to do. But you can do that by repeated effort, we'll say. And so we want to put this into our QC space, where instead of having people look at it and verify, is this factual or not, the machine can take a first swipe at it. You put in we tell you, give us a picture of all the bathrooms. Well, the machine looks and sees that it can find 3 toilets. If it does, you check, you pass, you got 3 bathrooms. But if you said it was 4 bathrooms and they don't only find 2 toilets, well, then we raise a flag and say, lender, you should look closer because we might have an error here, right? We want to use that kind of technology as a first pass to help us. Again, we're striving towards factfulness and verification of factfulness. This document objective facts. Avoid using words that suggest that you're biased. Now, I'm gonna be the optimist here and say we're not biased, and we really are objective and factual in our approach, or at least most of us are most of the time. We try to be, right? We all aspire to this ideal. But when we say certain things, it sounds like we're being biased, right? You can look this one up online. It's in one of our newsletters from a couple quarters ago. I know we're short on time, so I'm going to skip over it. But you can translate your language from subjective language that makes you sound biased into objective language where you're dealing in facts. That's a much stronger position to argue from. So your opportunities, ways to increase your credibility. Talk to your customer. Find out what they think. They have a lot of information. They may have some sense of what the problems are already, right? What do they need to learn from you? What sort of technology are they using to QC you? You should have some understanding of that. Second of all, embrace the new data sources and technologies. They're not going to go away. I hope one thing you'll learn from this is that they're actually very beneficial to the people who need appraisals. And they can be very beneficial to you in making your appraisal more reliable. So embrace it. View markets holistically. Don't overly focus on just a few comps, but think very broadly about how the market's behaving and what a person might do. A quick anecdote. I see George is like, we're not going to get to questions, but when we bought our house, my wife and I looked at literally hundreds of houses. I don't even remember how many, 400 houses online. Okay. From all of those houses, that online shopping that I did, I narrowed it down to, I don't know, 20 or 30 that I printed out. And I said to our agent, I want to look at these houses in person. And we went and toured those houses in person. They were not 3 houses in a single neighborhood. Like, we looked across 3 different cities, municipalities. We looked at a whole bunch of different neighborhoods. That was our market, right? That's how people shop. That's how markets work. I'm not saying you need to put comps from different cities on your report, but you need to think about it more globally, more broadly about what would a person do if they were shopping in this market. Derive the adjustments quantitatively. On that one, I'm going to defer to George. Like, he's got great classes teaching how to do this, and I can't do justice to this. But that's what we do at FannieMae, right? We use statistical analysis to try and understand what the markets are telling us. And you go with it. Whatever it says is kind of like you have to accept it. It's a reality. It's factual again. Explain. Now, how often do we, in writing our reports, kind of sweep stuff under the rug? You see something weird, but you know if you say something about it, the underwriter is going to ask you, and so you're like, best comps were used. Property conforms, right? We have to explain ourselves better. And again, because your customer sees the same things that you see, and they need to understand it, you can give them the context that they need to make a good decision. And then the last thing is just think about your own biases. Okay, we have a bunch of resources on the FannieMae website. I think this is a little bit underutilized, and I'd like to encourage you all to check it out. And with that, my voice is gone, and back to George.
Thank you very much, Lyle. Really appreciate it. Cindy, can you give me the screen back? A quick review of what Lyle said, at least in my mind. Opinion is more vulnerable to dispute than fact. So that's one area we're vulnerable to bias. Accuracy, not credibility, drives what FannieMae does and what all of our clients are really looking for. They want to be able to depend on it. Consistency and reproducibility is possible today. What's needed is the training and the software that enables it, which is where we go in my classes, and particularly lack of certainty. Actually, this is one of the things that is required of appraisers in my mind, is the ability to understand that almost everything has some uncertainty to it. Lyle mentioned the size of a house is a fact, and yet there's still some uncertainty in the measurement of it. So our goal is to get that uncertainty down as tight as possible. So when two appraisers do it, two analysts do it, they'll get very close to the same number. And the goal is accuracy and reliability. Accuracy is getting to the right number, and reliability is how sure are you of that number? What's the variation of it? Some of Lyle's graphs showed that. So accuracy and reliability. Think the words trueness and sureness. And actually, those words are starting to come into statistical literature now, because they just kind of are more intuitive. Trueness to the right number, and sureness, how sure are you? What's the uncertainty level? We get to that by using the complete market segment data, which, as Lyle mentioned, could include other neighborhoods. It certainly does. The complete market segment, whatever competes with a subject property. We measure the market, not compare comps. I believe that the day of 3 comps is probably over. The day of 10 comps or 30 comps or 300 comps is where it is. And that requires our ability to see markets, see neighborhoods, see towns and cities, and follow the protocols that lead towards reproducibility. We're completely unused to those. So that's part of the learning and changing of attitude, and actually even unlearning some old habits are really some of the hardest things. Reproducible analysis requires consistent procedures, documentation at all points. What data did you use? What and why? Either by identifying the parameters of that data search, or by simply forwarding the entire data spreadsheet or database forward with the appraisal. I believe that's where it's going, because the cost of transmitting electronic data is effectively free. There's no reason not to. And that is the element, the key to why it becomes reproducible, and somebody else can follow your work 3 months, 3 years later, and get pretty much exactly the same answer if your modeling decisions are clear at each point. And that's integration of your judgment so it's clear on what decision you made. I'm going to skip over this one, but this is, no, not. This is, I put a lot of effort into this. This is my perception of where we're going from traditional appraisal to evidence-based valuation. Traditional appraisal relied on personal judgment. I had good training in that area 30 plus years ago. In modernizing methods that we're going through now, it's going to be assisted judgment, using the computer power to help your decisions, help your expertise. In the long run, we're striving for optimized or approaching perfection or excellence in judgment. Traditional appraisal: identify the subject, pick your comps, make adjustments, reconcile the three approaches, and write a written report. I believe this write a written report is also a thing of the past. I think three to 5 years from now, we will not be writing reports of any kind. I don't believe Fannie Mae and Freddie Mac are coming up with reports in spite of his prior announcements about that. It's going to be a data stream. Our job is going to be to modify and improve a data stream, and various users will look at dashboards that are appropriate to them. A risk analyst will look at a different dashboard than the review appraiser, than the underwriter, than the regulator, than the portfolio manager. Evidence-based valuation: we're focusing on the competitive market segment. We optimize that data set. We apply our 3 predictive tools. Integrate the reliability score by looking at the reliability and risk involved in each step of the valuation process, and deliver via that data stream and dashboards at the receiving end. So how do we get from one to the other? Well, on the traditional method, the subject is the focus. The future, the market is the focus. In the past, 3 comps, 6 comps was fine. In the future, we're going to use all the data that's available. If you've got all the data or substantially all of the data, there's absolutely no reason to throw away, to discard perfectly good information. Our job is going to become how to suck as much understandability as we can out of the availability, out of the data that's there, not thrown away. In the past, we relied on our experience and support for our opinion. In the future, it's measured reliability. In the past, it was a storyline explanation along with the comparables that illustrate the market to us. In the future, it's numerical scoring of market parameters. And the written report was static. The only way you got to any feedback or dynamic results is when the reviewer said, "Hey, I disagree with Anya's, can you fix it?" And it was a 3-day process. Dynamic reporting can be interactive, literally, for underwriters, reviewers. If the data is there, it'll enable them to do their research. I hate to even use the word review, the audit, and yet if they have a different opinion, it'll be clear on the difference of opinions. We teach market price indexing as a key tool because it gives us present value of historical data. So if your best comp was 3 years ago, but it happened to be a model match across the street, and if you got a reliable time adjustment, that becomes your best comp. It expands your comparable data set, which improves your other adjustments. It provides a calculated time adjustment with really no, it applies to the relevant market segment, not the neighborhood, not the town, not the city, not the national price index, on what's relevant. It helps improve the accuracy of other adjustments, and teaching and learning market price indexing. It covers the entire process from getting the data to delivering it. This is one type of graph that we use for comparing 2 neighborhoods. Let's say that this is a box and whiskers, or a box plot. The middle line of the box is the medians. And if you've carefully identified the data, kind of like paired sales analysis, if you've controlled both neighborhoods the same, the difference between these 2 medians is a really strong indication of your location adjustment. It works really well. So 2 primary graphs are used: a histogram to look at markets, to look at neighborhoods, to look at cities. It shows a distribution of one variable. In this case, it's the sale prices. So this is $50,000 box here, or bin. This is your highest price bin up here. And the scatter plot. In this case, it's the date of sale on the x-axis and the sale prices on the y-axis. So here's another way of looking at the market or market segment or any data set that you've identified, how to see it. The human eye cannot see 7 or 8 or 9 pieces of information in a table very well. A graph becomes understandable. Here's a price index time adjustment. That's a scatter plot for a market segment, a competitive market segment. The trend line is a simple linear regression. It's a straight line. Behind that straight line is a formula for the slope, least squares. That's the time adjustment. On the x-axis, you measure time in days. On the y-axis, price in dollars. So the slope of the line is dollars per day, and you simply apply that dollars per day, how far back your comparable sold. Why market price indexing? It covers the entire process from beginning to end. It's a great learning tool. You get immediate results. You can blend it in with whatever you're doing today. It just simply improves it. And in many ways, it's fun. You got the visual. You get to see colors and graphs and dots. It works from beginning to end, from your scope of work to the data framing to reducing to the competitive market segment. Helps you see that. Gives you a time adjustment that's a mathematical calculation, not a statistical probability, because it's for the competitive data, not something else. And it's visual, so it's fun. And it's concise and easy to deliver in a report today. So there's another quick example. Just got a few more here, and then we'll open it up for questions. Getting the right data is the key. Whatever's competitive, as Lyle mentioned, it could be the neighborhood, it could be the entire city, or it could be a neighborhood that happens to be across town. So we're focusing on identifying the data with evidence rather than judgment. We're going away from trust me, I know a good comp when I see one. Okay, here's what the market tells me about itself. This is the last graph I'll show. This is a histogram, and each of these bins is a price range. Here's the highest sale in this neighborhood. Happens to be $2.5 million. And my first judgment as an appraiser, I say, I think all my data will come from this neighborhood or town, which would be the red bins. That's an assignment data frame. So it shows a distribution, and this distribution is real typical. Real estate markets tend to be skewed to the right with a couple of outliers. This is amazingly common. And then from that, I reduce the data I've downloaded by property type, by finance transaction, by time. I've already done a time adjustment, features, and that would be the green. So if the subject property then is right in here, look at that. One picture. The red is the data I picked, and the green is the data that's competitive to the subject property mathematically. And I've got a line right there. How does the underwriter review feel about the job you did with one picture? It's beautiful. Starting from the data you picked to the data that was analyzed to where does the subject fit in that. And with that, I think we're done. I'm going to open it up for questions. If we have a little bit of time later on, I would love to do a live example, both in Excel and in RStudio, going from beginning to end on what we teach in my class, but that's not the purpose of this webinar. The purpose is Lyle, and any questions you may have, I will open it up. Cindy's been looking at your chat questions. Bruce Hahn is also helping us. There's 2 or 3 other people here, long-term friends, been to my class, part of our community of asset analysts. Before I turn it open to questions, I'm going to kind of close. That way, if anybody wants to leave, you can. But here's what we're doing. We support the community of asset analysts. Stuff we got coming up is Stats and Graphs class next week. If you subscribe to the Asset Analyst Report for $199 a year, we give you half price for the class. Probably February or March or April, Scott Reuter, FannieMae is going to be the Lyle Radke of that month, and give us an update. There's a lot of changes going on with Fannie and Freddie, and I think we may have Lyle back in 6 months or a year, because I know things are changing. And we are developing a class for reviewers and underwriters on evidence-based valuation fundamentals for lenders. I don't know if it's going to be 4 hours or 7 hours, but it'll give them a checklist sort of on what the right procedure is for evidence-based valuation. And with that, I will open it up for questions and turn it over to Cindy with Bruce's help.
Hi, I also was sending things to Bruce as well as to Joe Lynch, who's here helping out as well. What I would really like, if you haven't already sent a question to one of us, raise your hand in the reactions. There's a little box down there that says you can raise your hand, so we can see who wants to ask a question. Bruce, do you have any questions or anything of that you've been sent?
I do. And before I read one of them, or any of them, I would just like to make a comment. There's a lot of really good questions here, but I have a general observation that I think is probably, after listening to Lyle and having listened to George for a long time, I think they're both saying the same thing. And I know change is hard. A lot of these questions are coming from the mind frame of, I've always made adjustments. This is how I've always done things as an appraiser. And I think what I just heard Lyle say and what I've heard George say, change is coming, and maybe those old methodologies don't work like we think they do. So I would just humbly suggest to everybody, keep an open mind. I'm not really sure that all the adjustments that appraisers should make mimic the actions of market participants, nor are they warranted. And I think if you actually get to the right data and use all of it, it makes some of the adjustment needs go away. That said, I'll just kind of start at the top. Ed asked or said that, for instance, in New York, they don't follow the ANSI measuring system. And he says to be consistent with USPAP, we need to follow what the assessor does. I'd throw that out. I think that comes back to modeling and making certain, it comes back to describing what you do, but I'll see if Lyle or George want to address that.
Well, my reaction is assessors all over this country do things in wildly different ways. So I'll just stop there.
Agreed. Yeah. So this becomes a local problem. That's part of what the appraiser as analyst is going to have to do, is say, okay, the assessor approaches it this way, the MLS maybe does it that way, and ANSI says it another way. I can tell you how these things map, right? I can reconcile this, unwind this mess for you. That's going to be part of what an analyst has to do.
Yeah, there are quite a few comments here that regard some of the charts that Lyle showed, and just raising questions or issues that different things could be accounting for different results. I'm not going to relay those. I think those were probably comments and not invalid ones, but I will leave those go. Ed also mentioned that price per square foot includes everything else, land and amenities, and I think he's probably referring to the fact that you could double adjust if you're making adjustments, because I think he's inferring that the package price, even on a per unit basis, has all of those elements built in. Does that make sense?
Yeah, I'll tackle that real quick. So it's true that it has a price per square foot from a market has all those things built in. So you wouldn't adjust, let's say that in your market, the median sale price is $100 a square foot. I'm not saying you should adjust $100 a square foot for square footage, because no, that's got a bunch of other stuff baked in. But there's some of what I didn't share is that this $35 a square foot has been pretty flat for about the last 5 years. And in this, at the same time, you see cost of lumber going up and cost of labor going up and cost of finished materials going up. And all of those things contribute to the square footage, right? So if cost is going up, it's not unreasonable to wonder whether or not that's affecting market. And demand is certainly going up. So I think you still have to go into the market and take the data and extract it. But I'll give you just a quick rule of thumb on how you can sort of judge whether or not you're doing this right. And this is, I mean, you guys know this, right? It's the paired sales type approach. You have a comp that's bigger, and you've sort of normalized for as much as you can, and you have a comp that's smaller. You apply a square footage adjustment rate. If you apply $35 a square foot, that lower comp is going to come up, and that higher comp is going to come down. If they meet in the middle, you got the right adjustment rate. If they don't converge, you're not adjusting enough. If they cross each other, you're adjusting too much. It's really simple math, right? And what we see is a lot of this, a little teeny tiny love tap. They're not converging.
Craig would like to know if FannieMae's done any testing on the 3D measuring devices for accuracy or reliability.
We've done some, and I saw somewhere in the comments somebody saying they've tried a few of them and didn't get consistent results. I will say that this technology is new and emerging, and there's still a lot of work to be done. You have to start somewhere, right? Technology just doesn't spring forth full-blown maturity in one step. I think it has tremendous potential, but we've worked with some of these providers very recently on ironing out differences in standard. So for the 3D technology, we prefer the ANSI standard, and we've asked them to do this to ANSI standard. There's a couple things in ANSI that are kind of hard to interpret, and they maybe didn't start with ANSI, and so they're evolving, right? Over time, these things will get better, but it also depends on what benchmark you're using. So if you say, I'm using public record as a benchmark for measuring this, well, I would say your public record is less reliable than your emerging technology. It's not really a very good benchmark, right? So we have done some testing, but I do think that this is going to continue to get better over time.
Another question is, will Fannie change the expectations in the neighborhood section of the URAR so that we can look at and report it the market in a holistic manner?
All right, so I got 3 answers for this. Answer number 1 is the forms technically are jointly owned by Fannie and Freddie. And yes, we are undergoing a process right now of creating the next generation of UAD and appraisal forms. And the neighborhood section is going to evolve for sure, yes. That said, you should never let the form limit your analysis. So if you need to do analysis in order to be accurate and reproducible and all those good things we've been talking about, then you do the analysis. And when you're done, you got to somehow jam that into the form, but you don't let the form limit you so that you don't do the analysis, right?
Form's really a reporting tool, it's not to drive your analysis at all. It's the tool to report.
If that form's inadequate to display your particular genius on how you've developed your opinion, then figure out how to put the rest of it in there somehow, right? And that's right now you've got your narrative comments and your addendum. They're available to you to do this, but in the future state, we think we're going to have a more dynamic reporting tool that will help with this.
Okay. Jim asks, is George using anything like cluster analysis followed by principal factors, principal components analysis?
I guess I'm stuck with answering that. Well, as Bruce well knows, in our stats, graphs, and data science 2 class, which we have only been able to offer once or twice a year, we do have my mentor in this field, Charlie Abramitis, has twice showed us how to do cluster analysis in using R, which is the open source software package we prefer. Cluster analysis is one of the probably one of the better, let me back up. data science is substantially about getting similar data. Does that sound like picking comps or picking the right market segment? And cluster analysis is one of the more straightforward ones, but there's actually about 10 or 12 different types of data analysis, data science, analytic tools. I don't care if you call it artificial intelligence. I don't care what your name you put on it. It's one of several tools. I forgot the second part of the question, Bruce.
Principal factors, principal component analysis.
Yeah, that's something we've never not taught. I'm aware of it. I had it in my graduate classes in econometrics in particular. In the long run, I think we will have to go to principal components analysis because it's a refined form of multiple regression, if you will. But then you get other problems. But PCA is an absolutely wonderful tool. To my knowledge, there's never been a journal article written about it for evaluation or appraisal. It may be 10 or 20 years away. I don't know, but it will come.
How are appraisal waivers reviewed or audited?
We have a whole ecosystem of exams and audits at FannieMae, and I'm sure it's the same at the other GSE, where we've got our first line of defense, which is operations. My team is in the first line of defense. We've got within that we have our LQC team that I mentioned earlier. They do a sample and some review work on appraisal waiver, loans delivered with appraisal waivers. We've got a second line of defense, which includes a model risk management team, which is independent of the first line of defense, independent of our modelers, and they do challenge testing of our models, and that includes appraisal waiver. We also have a separate segment, which is fair lending review, which all these different systems, including appraisal waiver, have to undergo fair lending review. And then the third line of defense is internal audit, and they will also challenge. So within FannieMae, we've got these three layers of challenge that happen. But we are also a highly regulated entity, and our regulator, the Federal Housing Finance Authority, they regularly examine us, and they also challenge on, and they can choose to challenge anything they like. We've recently undergone an exam of our appraisal waiver methodologies, and so that's just part of the landscape that we live with. Is we have to be able to demonstrate model performance testing. We have to be able to rigorously defend how we use modeling and the decisions that we make around appraisal waivers, for example.
Another question is, with the growing use of hybrid appraisals, is it likely that trainees will be able to do the physical inspection without the supervisor present?
Well, the good news is trainees can already do the physical inspection without the supervisor present. The consequence of that is you have to have your trainee sign on the left. We love that. And so, it's already a reality. In the future with a hybrid appraisal, we are using hybrids in a test, a pilot. And in our test, FannieMae, in collaboration with the lender, select the person who does the entity that manages the inspection. So the appraiser is not involved in that. And then what happens with the appraiser, they're essentially doing a desktop where we will give them a bundle of data and ask them to do the market analysis. So in that sense, can the appraiser send their trainee to do the inspection for a hybrid? No, because the inspection's already done before the appraiser arrives on the scene. But do trainees do that kind of work? Yes, they do. In some cases, they do. Now, is that the way that this is going to be in the future? We don't know. It's a test. It's a pilot. It could change, right? So we'll see.
Question about all the data that gets collected, much of it from appraisers. What is the problem with providing this data and the analysis tools and utilities that Fannie uses with lenders? What's the problem with providing that to appraisers? Does that make sense?
Yeah, makes perfect sense. I think, first of all, there are there is some of that information that we would like to share with appraisers. And I think long term, we'll probably get there where we will share more information with appraisers, particularly when it comes to the analytics around interpreting the market, that you could put some things in front of the appraiser that would help them to see the market, read the market better, right? So we'd like to do that. I think there are some headwinds, though. The first challenge is, and I think the question might have referenced what we share with lenders. We have a contractual relationship with a lender, right? The lender is selling us loans. We're giving them money. We have a contract. The contract says you will do X, Y, and Z. We can very much control data flow through that contract process. So we put obligations on the lender around how they use that data, and that protects everybody. It protects not just Fannie Mae and the lender, but it protects the appraiser and the homeowner and the people whose information about their house is being shared, right? We don't have contractual relationships with appraisers. That's a primary market function. So that's a big problem. How do I obligate appraisers to use data responsibly when I don't have a contract with them? So that's something maybe there's a way to figure that out, but that's not a natural part of the landscape. Appraisal this goes back to our congressional charter. Appraisal is a primary market function, and Fannie Mae is in the secondary market, and there's a wall between us. We are not allowed to operate in the primary market. We're not allowed to make direct loans to people, and there's a bunch of functions in that primary market that we have to kind of tread lightly around. So that's why I do these kinds of presentations. You remember that slide where I'm like, why does Lyle go talk to appraisers? It's because I don't have a contract with the appraisers. I can't really force the appraisers to do anything. They have a business relationship with the primary market. And so everything gets shared with appraisers through that filter. So that's a big challenge for how do we share with appraisers, is that we're not financial counterparties. Now, that said, there's another problem. Well, there are a lot of problems, right? So there's questions about confidential or private information. You want to be careful what you share. But there's another concept which you might call leading the witness. Now, we really want appraisers to do their job well and to help us manage our collateral risk. There's, I think, a temptation, a human nature, and maybe this is illustrated by confirmation bias. If Fannie Mae, in all of our magnitude, for what it's worth, comes to you and says, here's what we think is happening in this market, how often is the appraiser going to challenge it? If you challenge it, it leads to a whole bunch more work. Now you're fighting City Hall, right? You have to explain yourself. So we run the risk of leading the witness and only getting the answer that the witness thinks we want to hear instead of getting the truth. So we have to be really careful how we do this. Last thing I'll say about this is I think all these problems are solvable to some degree, and we would like to solve them, but it costs money and it costs time and effort. And even at Fannie Mae, there's only so much bandwidth. So these things may get done, but they're going to get done in turn. This whole technology is still very new and disruptive, really, and we're still figuring out what it means for lenders and for Fannie Mae to some degree, right? So it's we're incrementally doing more as time goes on, and I think we'll get to the appraiser as soon as we can. But it's a really complicated problem for us.
Thanks, Lyle. I'm going to turn to Joe because I know he has some questions too.
Lyle, thanks a lot for your time and reaching out to engage directly with us. It's much appreciated. Brady asks, why are there not tools created for appraiser use? I think you just addressed that the lack of direct engagement with the appraiser. Also, why is there not an appraiser support line regarding questions in the selling guide?
We have an inquiry intake mechanism. And if you go to that resource slide that I showed, second to last slide, it shows you how to contact us.
Great. So click on that and then you'll get an email submitted. Excellent. Ramona asks, is there something on the Fannie Mae site to review our reports?
Say that again. Sorry, I didn't quite catch it.
So most software vendors have a review function before you submit the appraisal. And I think she's wondering, is there something where FannieMae, we can upload a report to FannieMae and get back a review? I think that's what she's asking.
When appraisals come into the Uniform Collateral Data Portal, we run them through our Collateral Underwriter tool, and that generates an output which includes risk scoring and also quality messages, a variety of different outputs. We share those outputs with the lender. So we do have that automated feature. It goes to the lender. The lender is able to share feedback with the appraiser, but we do ask them not to take the automated results and just lob it over the fence at the appraiser, because that's really bad QC. A lot of what the machine can do is pick out discrepancies, but it doesn't mean they're bad, right? So you really need to open up the appraisal report and read it and see what it says. In some cases, it'll be self-evident, and you really need to look at the context in terms of all the other data. In some cases, that'll answer the question. So we want the lender to take first stab at it, see if they can answer the question on their own. And then if there are still residual questions, that would be when they would turn to the appraiser.
Okay,
Yeah, I remember seeing output like that when UAD was first turned on. So we appreciate it being hidden from us.
Well, we're at the 2-hour mark, and I don't want to hold Lyle over longer than necessary. I do want to mention that Bruce is a qualified teacher for Stats, Graphs, and Data Science 1. Joe also, thank you for being here, has helped me many times, and is an Excel expert, which is too bad because we're moving on to some open source software, but thanks to them. Thank you very much, Lyle. We can hang around some more. Even if Lyle leaves us, I'm sure I can be hanging around for another 15 minutes, half an hour easily. If there's any questions, comments, Bruce, Joe, anybody. I know there's some other very qualified people on my computer screen here. So let's give Lyle a great thanks. And if he stays, that's fine too. All right.
Well, thank you. Thank you for inviting me. And I really appreciate the opportunity to talk with you today, and hope it's helpful to you. You know, sometimes these things can sound critical. I don't aim to be critical, and at least not in the sense of saying appraisers are doing a bad job. I mean, I'm an appraiser, right? And I think we do our job very well for the most part. But the system that we have set up has some inherent risks, right? It has some features to it which produce unintended consequences. And I think in order for us to really be professional and excellent, we have to be aware of those limitations and then strive to overcome them. And that's, I think, what these tools and techniques are all about. It's addressing those weaknesses. So this was my last stop for today. I could hang around, 5 or 10 more minutes if there's any other specific questions, but George, you're telling me to go, I'll go.
No, I wanted to give you permission to go in case you were scared off. So, yeah.
All right, I'll stay. I can stay 10 more minutes.
Okay, two or three more questions, Bruce or Joe. Go for it.
There's a couple of questions I think that might be more aimed towards you, George, but maybe towards Lyle. There's a question from Matt Maddox. Will this type of analysis be good for desktop work? And I suspect that's regarding the evidence-based valuation, but I'm not 100% sure.
Well, I can answer that. The answer is absolutely yes. In fact, in some ways it's easier because you're working straight off the data. There's always judgment involved. And if you're not out there in the field doing the judgment, I do have to agree with that. Somebody else's judgment in there, and it increases the variability. The real question is, how much variability is tolerable? How much risk can the lender take? How much risk can FannieMae, Freddie Mac take? And if the appraiser's not inspecting it on a consistent basis using the same parameters each time, that reduces the reliability just slightly, at least. So,
well, I have one more question that I think is a real good one. Glenn wants to know if you have any thoughts on incorporating a range of value in a report via a dashboard, possibly, versus the traditional specific point opinion of value we're all used to.
Well, I wouldn't see it necessarily as a versus or one or the other. I could envision a scenario where we collect both, but the point value is still very useful. You think about calculating a ratio, LTV. This goes back to our fundamental business model. It's hard to operationalize a ratio based on a range. It's much easier to do this with a point. And there's this, simplicity in pricing is also an important thing, right? You don't want to go to Walmart and say, oh, I want a loaf of bread, and then say, well, this loaf of bread could be anywhere between $2 and $5, right? You got to know what the price is. And so we've got to grapple with that. But I think having some confidence around the analysis is going to be important in the future. I think ultimately we're still going to need a point for certain purposes.
Lyle, Jeff asks, it'd be nice to see our CU score overall and per file.
I would argue that it was not nice to see your CU score.
Yeah.
CU score doesn't tell appraiser anything. At least it shouldn't tell you anything you don't already know. It's a measure of risk. It's not a measure of accuracy or quality or anything that's really going to drive your behavior in a positive way. Well, again, thank you, everybody. George, let's do it again next December.
Thank you very much, Lyle. Thanks for agreeing to be here, and we really appreciate it. I'm sure everybody does. Thank you all. We'll hang around if you want to chat or just get to know each other. I've done a lot of these webinars and online freebies and stuff like that, and I find that some of the chatter that goes on afterwards, I learn more with that freeloading, free and easy stuff afterwards. So, Lyle, thank you. We'll say goodbye to you then, and I'll hang around for at least half an hour or so if you want. And Bruce, Joe, you can hang around. I know there's some other names on here, people that have more answers and questions for me. Thank you.
Thank you for being here. Thank you, Lyle. He's gone. Boom.
Okay. Okay, now we can really talk.
Perfect.
Hey, George, I would not dare step on Mr. Radke's toes there. I would just say ditto to what he said.
Oh, no problem. I understand. That's great. Yeah.
Ditto, double
Yeah.
ditto.
I really just want to acknowledge that you're here, and I appreciate you. I've known Danny for many, many years, and I appreciate your being here.
George, who's doing the inspections on some of these properties when they give them to us for desktops? Since real estate agents and appraisers don't see eye to eye on every aspect of the house, and we're supposed to rely on that data, who's doing the training?
When you say you're getting that, so you're talking about the hybrid, not the pure desktop.
Right, the hybrids, I'm sorry, yes.
Yes. I can't speak for that other GSE that's on the other side of the river. I know that at FannieMae, when we do, we are also conducting some testing in this department, and we have training requirements that we impose on the people who are doing the inspection component. And I will tell you that it is one of the, it has been historically one of the most, I think people have been surprised when they submit their training, because I don't think anybody at this point has gotten through the process with less than 3 revisions, because they have to pass the eyeballs of every appraiser that works for me. Right? And that includes a lot of people with a lot of experience. And so we're pretty, we're probably the reviewer from hell when you're looking at our training requirements, right? And then what we do is we do conduct our test and learns, we gather files in, and if we see issues, we go back to that provider and provide learnings based on our observations. So you provide an example there. If somebody included something inappropriate in a square footage, we would go back and talk to our vendor and say, hey, look, we've seen this 3 times from 3 different inspectors. You clearly need education and training on this, right?
Very good, thank you. I want to recognize one other person. Keisha Wilkinson is on with us today, and she's the education person for FannieMae. And thank you for being here, and hope this all helped you. Glenn Kangas has a raised hand.
Yeah, I've at the summit, I talked to two of the vendors that are doing hybrids. The one I think is for Freddie Mac and one's for FannieMae. The one is using brokers to do inspections, and they're using Cubicasa for the measurement process. And then the other one is using various vendors that they supposedly train. I've done 3 or 4 for them. And it's just clear that the person who's doing the inspection is not trained as an appraiser. And that's, I've had multiple conversations with them about it, that they just need to use trainee appraisers for that. Plus, that one is using a 3D scanning software, which actually takes probably twice as long to do the inspection as it would for a trainee appraiser who's been trained by me or whoever to do the inspection. So it seems like it takes longer. It does allow for you to tell them to make changes. I found some issues with some and they did fix them, but it just seems like it's actually a longer process to me than if they just sent me the order and I sent my trainee appraiser out to do the property the way I properly train them. So I think they're trying to make things faster because they think there's a shortage of appraisers, but I still think the solution is the trainee appraiser who's trained under our supervision. So it's a mixed bag. From my
on those hybrids, then do I have to rely on what they've provided to me, even though I would consider it to be different?
Well, you actually have the one vendor that I've done the work for. They allow you to tell them that something needs to be fixed. The one actually scanned where they couldn't scan the whole garage because it was a hoarder. So they're actually missing a piece of the garage in the scan. And then there was a garage conversion too that I had to have them fix square footage wise, where it was being included and it shouldn't have. So they do allow you, they are capable of making changes to make it appear, seem like more accurate. But, obviously as appraisers, we would prefer to be the ones that verify that.
Right.
All right, thank you. We do have a couple more hands up. But Matt Maddox, I think you've had your hand up the longest.
Well, basically what Glenn has been saying is what I've been running into. I've been doing a lot of desktops over the past year, medical reasons, but I find that their inspectors are they say that they're brokers, but who knows? I've been told by many people in the real estate business that brokers don't go out there and do these things. They're all given to real estate trainees, realtor trainees. So with that said, it's the point. What Glenn was saying is exactly what I've been seeing. These aren't people that have been trained by appraisers. I find that I have to contact the AMCs and tell them, hey, this is not good. As Glenn says, I don't see how they're saving any time. They're because we've got here's one of the things is I've got to go into these appraisals and I've got to look at what the photos they're giving me And I'm trying to figure out, well, where the heck is this room that they're calling a bedroom is located within the floor plan that they're giving me? Um, I'm looking for a functional obsolescence, and there's been times where they had a the the sketch came to me that was done on one of those uh, Casa, or whatever it's called, the mobile device, and they had a converted garage that was showing a a triangle of a space that they were calling a garage, and it was only like 4 square feet, and then they had this converted garage as a apartment that was only accessible through a closet to go into the laundry room that went into the regular, uh, the main house. So I'm like, well, that I don't know if that's functional. I think it is, but I just thought that was just ridiculous the way I saw this. So and then you've got to figure out, well, there's just so much stuff that needs to be worked on.
All right.
The AMCs need to hire appraisers.
Thank you, Matt. Let's give Paul Middaugh an opportunity here. Paul, please go ahead.
My concern is with the gross living area. Our local realtors use the county records for their gross living areas. We all know it's wrong. And we moved by ANSI, we're comparing apple to oranges. How do we justify that?
Anybody?
George, this is Todd Reddington. One of the things that Fannie does allow is that you are able to override, quote unquote, I guess override's the wrong term. Fannie wants you to use what market participants in that segment use to make their determination on purchasing and value. So if ANSI is not what those people use, you can measure to ANSI and you can identify ANSI in your report, but you can also say, hey, that split entry that's only got 2 feet below grade that the assessor is calling above grade, because all of the MLS market systems are calling it above grade, and that's how people buy things, well, then you can too call it above grade. You just have to address that within your report. And so sometimes ANSI works and it's appropriate, and sometimes it's not, and it's very, very market driven. And that's my interpretation from the conversations that I've had with different representatives, and my interpretation of the selling guide. But you're always able, if you're able to show it, and just one of the other things is 0 bedrooms above grade is unacceptable. Well, if you're on a hillside and you walk in the front door and your first step is down, you're below grade. So, you've got to be able to address and be flexible within the report. And you can do that as long as you discuss it and address it and prove it within the analysis. So
very good. Thank you, Todd. Brian, what's your last name, Brian, when you come on? Brian?
Last name's Brooks. I just had a question about, you were mentioning multiple regression it's not credible, basically. Is that what you're saying? I'm not sure why I can't do like a GLA and like a bedroom count in multiple regression, and you're saying that would not be a good idea to use that information.
Well, I will answer by telling you a story. I have a lot of education, multiple regression, and I know very little about it. I've had at least two full-time graduate level, PhD level courses in that. I still don't know much. About 10 years ago, I decided to give a class, 7-hour class on multiple regression, and I've never taught it again. Basically, what I discovered in teaching that class were all the reasons why appraisers shouldn't. It's really complex, it's convoluted, dealing with missing variables, variables that correlate with each other, both positively and negatively, and the fact that the correlation, the regression coefficients do not match at all what we do as appraisers for adjustments. The adjustment factor that we use theoretically is holding everything else fixed theoretically, which of course is impossible, but we do the best we can. Multiple regression doesn't give any consideration to that at all. It just considers only the variables in there. And as a quick example, one of the field that I do a lot of expert witness work in views, and the house will be worth $500,000, the lot's worth $600,000, and the view's worth $3 million. And if you miss that view, the regressions are going to give you garbage. Getting back to, why do we need appraisers? There's a reason. But multiple regression, in my opinion, should not be used at all.
Hey, George, can I
Thank
jump
you.
in?
Yes.
I think the answer is in what you covered in some of your earlier slides. The sales comparison approach is a model, right? The adjustment grid on the GSE forms is a model.
Yes.
I had this discussion many years ago with when StatWing came out, and all the appraisers were rushing to StatWing and using the coefficients as adjustments. And I talked to their chief math officer and I said, I'm sorry, I have a lowly bachelor's degree in applied math, but you're taking the coefficients from one model, the model you built in your regression, and transferring them over to another model and assuming it's the same, and it just doesn't work. And their CEO was arguing with me, and then their chief math officer said, actually he's right.
They are not the only commercial software provider to residential appraisers that has done that.
Yeah.
So that also, and I think it's a disaster. It's a damn shame.
I've had this conversation with David Braun several times. I don't really have an issue with regression as a tool for appraisers, but the problem I have is the people teaching it are not teaching it in an appraisal context. They're getting the math right, but we're not getting how to apply it in an appraisal right.
Well, thank you very much. I do need to say one more thing to make sure that nobody leaves here thinking George is against regression. In my class, we teach regression, simple regression. The key to it is knowing when it works and when it doesn't work. That's the key to it. And one of the keys is, of course, getting the data right. So that's covered in the stats, graphs, and data science class thoroughly. It works really well when the conditions are right.
George, I don't know how to raise my hand. This is Scott Cullen.
Hi, Scott.
But that last comment about multiple regression being a model, we cannot take one part of that model and leave the other ones alone, right?
Right.
We've got to take all of the coefficients out of a multiple regression model and don't use anything else. Several years ago, I did a regression model in my area. I used over 200 houses to generate the equation. And then I ran 30 houses that had sold through that regression model. And as a group, I totaled up all 30 predicted prices and the 30 actual prices, and it was within 1%. But individual houses would be 10 or 20% off in either direction. So it only works for a group of 30 or more houses, which is ideal if you're managing a portfolio, but it's useless when you're appraising one house.
Right. I'd like to mention that Scott teaches classes and provides software also. So thank you for being here, Scott.
Seth Cullen or Seth Kupar, did we answer your question about multiple regression?
Oh, no, I was just wondering what book that at the beginning of the class that George said that because I do property tax consulting too, so and they do multiple regression with stuff. So I was just like, the book that says that multiple regression is not good for appraising, or I might bastardize what George said earlier, but you said a book has something about multiple regression not being good, I guess. I don't know if I'm saying that right.
There's just so much to it. It's complex. Yeah. It's like building a new econometric model for every appraisal. And we cannot take the time for the fees that we get to do multiple regression properly. It's just really, and it requires a huge amount of knowledge.
I think what he was referencing was the FAQ response from FannieMae saying that the multiple regression coefficients should not be utilized in the appraisal process.
Yes, and that's in the Appraisal of Real Estate too, the Appraisal Institute's book. Flat out. That's exactly what it says.
And I think you can clarify that, George. I'm not saying the regression can't be used for an appraisal, but it shouldn't be used as the basis for the adjustments on that GSE grid.
Right. Right.
Jim Plant, you've got your hand up.
Oh, yeah, I'm in here. Yeah, and the mic's working too. Okay. George has put a lot of emphasis on this evidence-based appraisal. And of course, measurements play a great deal of our primary components in the appraisal of anything. So you've got GLA and of course, rates and other ratios. Well, the point I wanted to make was that any measurement by anybody, including a registered land surveyor, is nothing more than an opinion, same as an appraiser, and subject to the shortcomings of those opinions as well. You can take the 100-foot tape in one guy's hand and put the disto in the other guy's hand, and the disto guy says, well, that's 39 feet, 2.5 inches wide. And the other guy says, well, you're wrong. It's 37 feet or something like that. Maybe his tape is shorter. I don't know. But who's right? You've got two experts in there. One of them flat knows he's 100-foot tape, and the other knows he's using a laser, by gosh. And you can't put that aside because that's really accurate, right? You drag in the appraiser and he'll prove them both wrong. Or the surveyor, I mean. So how are you going to address that in the evidence-based appraisal context where you've got evidence that's based on opinions?
Well, you've reached out for too extreme, and remember our definition of subjective versus objective. In fact, I even said two appraisers measuring a house are going to get slightly different numbers, but the fact of the house is what it is. It's a fact. The measurement will have some variability. Let me finish here. The whole point of this is that understanding how much uncertainty there might be. Measuring one length of one house, you and I will come within probably 1/2 inch or an inch.
Yeah.
Going around the house, we might come within 5 or 10 square feet. So it's a matter of how much uncertainty is it. So we need to learn to have a tolerance for the uncertainty. And here's the real issue. When we start measuring that uncertainty, now we have yet one more product that we can sell the lenders and Fannie and Freddie and all the people who care about risk, not really a hoot about how much is that house within 1/2 inch.
Yeah, I agree with you, George, and I'm not trying to say that evidence-based appraisal is not a good thing. I was just delighted when Danny Wiley, speaking on another occasion, piped up and pretty much said that you and he were exchanging information on how to use data science to prepare an appraisal. I'm absolutely delighted with it because I despise the inaccuracy in the current methods. But thank you for holding these, and I'll bow out and let somebody else have at you now.
Thank you. We got more coming. We're going to do one every month until we run out of steam.
All right.
Anybody else? I'm running out of steam. All right. Hey, thank you all for being here. Please thinking about taking the class if you have any interest in what we've talked about here. I truly believe this is the future. I'm grateful for a profession that's been wonderful to me. My unique set of educational background and military experience is what got me here. I'm trying to give back to the world what I can and help the profession, help prevent the next economic meltdown. So there.
We have a February class that's going to be online. We have a face-to-face class in Boston in January, and we have the online class that's next week, starts on Thursday, right? Thursday, Friday, Saturday. So hope to see you there somewhere.
Thank you.
Or here.
Have a great weekend. Take care.
Take care, everybody.
Bye.